Good afternoon, everyone. We'll go ahead and get started. Hi, my name is Adrienne Gallegos. I'm with the New Mexico Small Business Development Center. Today we have Cathie Tardy joining us, who is a certified SCORE mentor and is a CPA and holds an MBA in tax accounting and has been the president of her accounting firm for 31 years. Cathie will be presenting tax strategies, keeping profits in your pocket. And thanks so much for joining us. Without further ado, I'm going to turn it over to Cathie. Cathie's going to run a couple of slides for me and go through a couple of things here. We will be using the Q&A function to take questions and welcome attendee participation. So don't hesitate to ask any questions you may have. We'll answer all of those questions at the end of the webinar. This slide features some COVID-19 business resource links, which I won't go over in detail, as we'll send you out a copy of the presentation at the end of this webinar. Please visit our NMSBDC website to view any of our upcoming no-cost webinars or to sign up for our no-cost counseling services. I'll also send a follow-up email to you with all of this information. So again, thank you for joining us, and I will turn it over to you, Cathie.
Good afternoon. Today we're going to talk a little bit about how to keep our profits in our pockets. I'm going to be focused on 10 items that will more specifically relate to this profit keeping. And I want to start first by talking about tax planning and where does it begin. So as small business owners, we want to do projections for the upcoming tax year so we get no unpleasant surprises. So some of the things that we need to consider when we're doing our planning is to, for one, consider the economy. We know there are lots of things happening out in our world this year, unlike prior years where we were pretty much focused on COVID-19, but we've got a lot of things happening. We've got inflation, we've got oil and gas problems, we've got the war, we've got all kinds of issues that are affecting our businesses. And more specifically, we need to look at our particular line of business to consider how that is affecting, how the economy, what's going on in the world is affecting our business. Are there recent events that have caused maybe your business to grow or maybe to decline? And so one way that we use to focus on this issue of the economy and how it impacts our business is to look to our industry groups to help us predict how these factors might impact our business so we can continue to do our planning with additional information that's going to impact us. And of course, and I tell my clients all the time, we need to look at your projections. We need to understand what's the expectation for business income through the end of the year. A lot of times my clients say, well, I don't know, I can't even predict next month. How am I going to predict next year or through the end of the year? So really, we do need to focus on that. We need to try to understand what's happening, and we need to try to put our finger on what our expectations are, because not only will this help us determine what we think our tax liabilities will be for the year, but it also will help us isolate and identify issues with our cash position, because this, of course, is extremely important for small business owners. we may need to review our current lines of credit to see if we can get those increased, and maybe potentially look at opening a credit card or something for the business if that's something we want to take advantage of. But knowing our projected business income, our revenue stream, where our expenses are expected to occur, will help us predict our cash flow, which again is so extremely important for our small businesses. In addition to the economy and our own projections, we want to look at our personal tax situation. And the reason I say this is because a number, or maybe I would even hesitate to say most of our small business owners are operating as some type of pass-through entity these days. And so it's important for us to understand other impacts to not only our business income, but our personal situation that will change our expectation for tax liability for 2022. So besides our personal situation, we want to look at business-related issues, and then, of course, any kind of tax-deductible personal expenses, as well as our own personal cash needs. So the goal here today is to figure out ways to keep our profits in our pockets, which of course means reducing income taxes that we will owe Uncle Sam. So the first item I want to talk about is our filing status, which on the surface seems like a pretty simple and obvious situation, but sometimes we actually are given opportunities that we're not even really considering. So of course, filing status can be either single, head of household, which generally is an unmarried individual who provides over half the cost of the home for a qualifying person. We could potentially file married jointly or married separate. And I just like to point out that generally married separate creates the highest income tax rate. Things that may affect our filing status during the year, of course, is potentially a divorce. And timing is so very important on this because the IRS says your filing status is what you are on the last day of the tax year. So if you're going through divorce and you get the final paperwork on December 30th, December 31st, you're single. So you're no longer married, unmarried individual. Things to consider along with divorce are community property split, because New Mexico is a community property state. And New Mexico does recognize some separate property, so that could also be an impact on your tax filing. Another status change might be the birth of a child, or even moving in a parent. So how does that affect? We want to talk now about who is a dependent, because remember when we mentioned head of household, we said an unmarried individual who has a dependent. So IRS actually recognizes two different types of dependents, which seems odd, but we have something called a qualifying child, and then we have something called a qualifying relative. So for both statuses, the individual who may be claimed as a dependent must be either filing single, married separate, or married but only filing a joint return to get the withheld income taxes back. The dependent has to be a citizen at least part of the year, either a U.S. citizen, a U.S. national or resident alien, or a Canadian or Mexican resident. And at least half the support must be provided by the taxpayer for this dependent. Now, a qualifying child is pretty much as it sounds: son, daughter, stepchild, foster child, adopted child, but could be even a direct descendant on one of these individuals who could perhaps be a grandchild. It could also be a brother, a sister, half brother, sister, stepbrother, stepsisters, or a descendant of one of those. So you can see a qualifying child really has more impact than just literally a child of the taxpayer. There's an age test for the dependent. They must be under age 19 or under 24 and a full-time student unless they're permanently and totally disabled. Their principal place of abode must be with the taxpayer for more than half the year unless they have some kind of exemption for either sickness, education, etc. You can see those on the slide here. I will mention that even though you have a full-time student and they may be residing in the dorms or an apartment near the college they're attending, the exception for education means that as long as they're enrolled as a full-time student, that will qualify as living in your home. So that student would still be considered a dependent even though they're not living in your home, as long as you're providing over half their support. Now, a qualifying relative is basically all of those that we already discussed previously, but it also includes aunts and uncles, nieces and nephews, and in-laws as well. The dependent must have their principal place of abode with the taxpayer more than half the year, again, for limited exceptions. But the difference is especially for perhaps children who are maybe age 20 and not a full-time student, there's a gross income test, and their gross income must be less than $4,400 in 2022. There is currently, for dependents, the taxpayer is allowed a child or other dependent tax credit. Children 17 and under qualify. Now, these rules are effective for 2022. The 2021 rules sunsetted, and so we're back to basically the rules in effect prior to the special changes for COVID. So children 17 and under qualify for the child or dependent tax credit. And of course, they have to meet the tests as some kind of dependent. The tax credit is $2,000 for a child and $500 for the other dependent. And there are phase outs based on your filing status, where your modified adjusted gross income can be up to $400,000 for married filing joint. Sorry, my finger clicked. And $200,000 for any other filing status. There is a portion of that tax credit which is refundable, and it's projected to be $1,500 per child in 2022. The second item I wanted to focus on to keep our profits in our pockets is considering retirement plans to help us achieve that. Now, different qualifications and contribution limits and dates of establishment. So let's kind of go over retirement plans, the different options that are available to us as small business owners. So we have a 401k, a solo 401k, an SEP, otherwise known as a simplified employee pension plan, a simple IRA, a Roth IRA, and we actually have a regular IRA. So when do we have to establish these plans? And just one reminder that I sometimes forget to mention, so I threw it on the slide, is remember your contributions are being compounded and earning. So an earlier contribution is going to grow faster. So if you're able to make your retirement plan contributions as soon as possible, even if you're only able to contribute a small amount when your business is young. So the dates that we have to consider are, for a safe harbor 401k, the plan must be set up by October 1st, but we can make contributions up to the business's tax filing deadline. And I'll talk a little bit about that in a minute. Now, a solo 401k is similar to the regular safe harbor 401k, but it is limited to the individual who is the owner of the business. Now, these can be established by December 31st, of course, effective for the subsequent year, and contributions can be made by the due date of the business tax return. Roth IRAs, regular IRAs can be set up and contributed to by April 15th of the subsequent year. The SEP can be set up and contributions made up to the due date of the business's tax return, including extensions. So if you're perhaps a pass-through S Corp and your tax deadline is March 15th, but you decide to extend, you can extend the time of making these SEP contributions up to the due date of your return, which extended would be September 15th. So sometimes that's a good planning opportunity to consider. A simple IRA must be set up by October 1st for the next business year. And if there is a plan in place and you're switching, it could be set up by January 1 if you already have some other kind of plan in place. So other things we want to think about along with these dates are we can't just set them up at the very last minute. We have to work through these providers of these plans, and so that can take longer than a day. For example, 401k plan, where you have to make determinations as to what particular aspects of the plan you want to consider and you want to offer, perhaps to your employees. May take a month or so, so do not wait till the last minute to consider a retirement plan. Be thinking about this ahead of time. And so I say no later than September 25th to try to set up any kind of plans. I specifically talk about Safe Harbor 401k, but I'm in agreement for all the other plans. Let's not wait until the end and then be scrambling or perhaps have an error made in one of our plans and we need to get it changed. So the maximum contributions that you can make to these various plans differ as well. For a 401k, the maximum contribution to a 401k plan is $67,500, and that's per year. The maximum deferral amount is the $20,500 plus if you're 50 and over, there's a $6,500 catch up. So that's like $27,000 that as the employee portion can be deferred from a W-2. The other portion up to the $67,500 is what the employer can contribute up to the plan, but it's up to 25% of compensation. So your W-2 must be big enough to meet the total $67,500. Now for solo 401k, remember I said for an individual owner with no employees is still that same number, the $67,500, and the deferral amount is 50 and over, $27,000, with the balance of, what is that, $40,500 that could be contributed to the employer. But again, the employer contribution is a maximum of 25%, and the it's 100% of compensation. That is what you use for the test. Now, a Roth IRA can be, remember, contributed up till April 15th of the subsequent year, and the current amount is $6,000. That'll be deductible, but you can add $1,000 for the 50 and older catch-up, so you can actually contribute up to $7,000. Now, no tax deduction for a Roth contribution because it is not a deductible contribution, but the earnings are growing tax-free, unlike the regular IRA, which creates a current tax deduction But when you pull out any money from the IRA, 100% of that will be subject to income taxes. The other comment I'd like to make about these IRAs is that it's either deductible or non-deductible, but it may still qualify for a saver's tax credit, which is one of the credits that are allowed when you file your Form 1040. So be sure to be looking for that when you file. The SEP, you can contribute up to 20% of self-employment income. So this would apply to someone who is filing, say, a Schedule C as either a sole proprietor or a single member LLC, or if you're self-employed through an S corporation, up to 25% of your W-2 from that. The simple IRA has a $14,000 limit plus $3,000 for an individual 50 and over, up to 100% of compensation. And so sometimes if we have a individual who has maybe a W-2 and he's contributing, year's contributing to their 401k through that employer, but they also have a side business, they may utilize the simple, and depending on what their income level is, they may be able to contribute 100% of that into an IRA plan for the year. So there's a number of ways to utilize these plans. And again, you need to be considering these early enough so you can determine what would be the best opportunity for you. The next item I wanted to discuss is Section 179. And I know a number of you know what this means, but essentially it means that instead of capitalizing and depreciating an asset over the IRS lifetime, you can actually deduct the whole item in the year you purchase it. For example, if you bought some machinery, let's say it cost $20,000, IRS says it has a life longer than 1 year, so you should capitalize it and depreciate it over 7 years. So you may want to try to get that tax deduction in the current year. So you say, well, I am going to elect Section 179 and deduct that whole $20,000 in the current year. Things to consider is that the equipment must be placed in service by December 31st. It's not good enough to just purchase it. You actually have to use it before the end of the year. Semi-recent changes to the laws do now allow Section 179 for rental property, which was not the case in prior years. But things I like to tell my clients too, let's make sure we actually need the asset and we're not just buying something we don't really need to try to reduce our income taxes. And let's consider our cash flow and financing options and determine when to purchase and if we're going to have to hit our line of credit or if there's financing available from the seller that we could take advantage of. Along with Section 179, we talked about capitalizing and depreciating. Well, bonus depreciation was reinstituted. We had it a number of years ago, but we haven't seen it in recent years, although it didn't go into effect these last couple of years, so we have seen it for a little while. But as you can see, bonus depreciation through 2022 is still 100%, but it's going to decrease through 2027 and be zero at that point. And I want to note that you can make a Section 179 election as well as take bonus depreciation, which we'll kind of get into in a minute. But bonus depreciation means instead of, for example, if IRS says the equipment you purchase is a 5-year asset and you're going to get 20% of the cost to depreciate over the next 5 years, bonus depreciation is in effect now. So actually we can take 100% of depreciation. So it actually kind of mimics Section 179, although it has different rules and regulations associated with it. But through 2022, we're still going to be able to take 100% bonus depreciation. Now, you don't have to take bonus depreciation. You can elect out of bonus depreciation. So again, we need to be planning so we can determine how best to utilize these rules to our best tax advantage. Now, what are we anticipating our income tax rates to do? I think everyone pretty much assumes tax rates are increasing. Well, not we, but the federal government handed out a lot of different PPP loans, some economic impact payments, all different kinds of help to our citizens for COVID relief. And so we're anticipating tax rates are going to be increasing. And there's been several tax proposals instituted or set out in Congress for discussion, and everything looks like taxes are going to be increasing. So what can we do if tax rates are increasing? Maybe we want to consider deferring deductions. We want to, instead of take that big deduction in the current year, push it into 2023, because the rates in 2023 are expected to be much higher. So again, this takes planning. We have to project. We have to understand where things are going. The state and local income taxes a few years ago received a limitation of $10,000, meaning property taxes, income taxes, all at the state and local level are limited to $10,000. So this is something that has an impact whether taxes are increasing or decreasing. We need to understand how that's affecting us. There are some states, New Mexico as well, looking at how to pay these state taxes through, even pass through entities, instead of passing them through to individuals. So it's something that we want to consider. Maybe we want to defer payment until 2023 of the second half of our property taxes, if that's available. Maybe we want to hold the employee bonuses that we've declared until Jan 1 to take advantage of that deduction in 2023 instead of 2022. Again, charitable contributions is another one where we have control over when we make them. So maybe we want to push them into 2023 as well. I wanted to mention credit card deductions because IRS says if you have charged something on your credit card during the year, even though you don't pay for that item until the subsequent year, you can still take that as a current deduction. So if we charge something by 12/31/22, we can take it as a credit card, as a deduction in 2022, even though we don't pay that credit card bill until January of 2023. So again, another potential planning opportunity. And I have included this slide, even though we don't really expect tax rates to decrease, but again, just to be thinking about what is going to impact our business and personal tax situation. There was a law that said we couldn't prepay taxes because when they first implemented this rule, individuals tried to pay property taxes in advance. And so the IRS came back and said, no, you can't pay them until they've been assessed. So we cannot do that anymore. So again, look to some of the pass-through issues related to these state and local taxes now through the pass-through entities. Again, we may want to pay taxes early if we can, pay bonuses early, pay charitable contributions, and know when our credit card deductions are eligible for deduction. So just looking at the opposite side. Another item that's really of benefit, and a lot of clients ask about vehicles and how that works for tax purposes. And that can be a big deduction for us. So the standard mileage rate for 2022 is going to be, or it is 2022, is 58.5 cents per mile. A log is required with the date, place, and business purpose of the travel. So don't skimp on that. We have seen mileage deductions get eliminated on audit because logs were not available. There are a number of apps that are available out there. I like MileIQ. I don't own stock, but look at it. It's very easy to use. Mileage is only deductible when we leave from our business office. And so we want to look at where our business office is. And if we don't have one, consider home office, which we're going to talk about a little bit later. Yes, you can switch between actual cost versus standard mileage rate. So besides taking a deduction for a mileage rate, you can also consider taking actual cost, meaning you add up all the costs of your gas, oil, repairs, anything having to do with your auto, and then based on your business mileage to your total mileage for the year, using that percentage to apply to actual cost, and then compare. What's the bigger number? Is it actual or standard mileage rate? Generally, I find standard mileage rate is a little bit bigger, especially when you have a newer vehicle. But sometimes actual costs can be more when your vehicle is aging and you have a number of repairs. So yes, you can switch between the actual cost versus standard mileage rate, but the first year you must use standard mileage rate for that vehicle. So just keep that in mind. Now, cars, trucks, vans are eligible for depreciation, Section 179, as well as bonus depreciation. But we have to look at what is the business use. So if it's 100% business use, it's really obvious. But we must use it over 50% for business to get these prorated deductions. IRS considers there to be 3 types of vehicles for these rules. There's the passenger vehicle, the SUV, and then vehicles over 6,000 pounds gross vehicle weight. A passenger vehicle is pretty much like you think, a passenger vehicle, and it's limited to 18,200, which includes both the depreciation and Section 179. So they have special limitations, and we can't take a full 100% bonus on them. The SUV, on the other hand, is eligible for the 100% bonus depreciation, but 179 is limited to 27,000. So you can kind of see the interplay of some of these rules, and we want to make sure we determine which one is best for us to use. Trucks over 6,000 pounds are eligible for a full Section 179, as well as 100% bonus depreciation. So yes, you can take the full cost of those vehicles for the year. And again, our car salespeople like to point that out, talk to your tax person. And so some of these vehicles literally are eligible for 100% deduction, placed in service before the end of the year. All right, we said we wanted to talk about home office. Sometimes people are a little hesitant about a home office, but they can be very beneficial for us. Do we need one for a mileage deduction? Do we need a business location we're leaving from, so every mile we drive we can take as a business deduction? So to take a home office, we want to make sure that we're using this as our regular and exclusive place for business. Now, that does not mean you must meet clients there. You may use it strictly for administrative or management activities. You may meet all your clients somewhere on the road, at their homes, at their places of business, but you must be using your home office regularly and exclusively for admin or management activities. It does not have to be a full room in your home. It can be a partial, like half of your room where you're regularly and exclusively using only that section of the room for your business. You may have your file cabinet, your phone, your computer, everything you need to conduct business right there, and you're using it regularly and exclusively for the business. Clients can be concerned about creating taxable income on the sale of the home, but depending on the size and how often you use it, meaning how many years and a number of other factors, generally I find that the home office deduction does not create a big tax liability when you sell your home. So consider it and see how it might impact your tax situation. There is several ways to compute the home office deduction, the safe harbor, of course, being the easiest, where you take the square footage of your home office to a maximum of 300 square feet and multiply it by $5 a square foot. So the maximum safe harbor home office deduction is $1,500. To use the more specific actual method of home office, you would add up all the expenses of your home for the year, including property taxes, mortgage interest, homeowner's insurance, utilities, repairs, and then take the ratio of the square footage of your home office to the total heated square footage of your home and apply that to the costs. So again, actual cost may or may not exceed safe harbor. So do the comparison and see what's going to help keep your profits in your pockets. Something else that we want to consider when we're doing our planning is, do we want to try to accelerate income? And generally, clients look at me horrified. What? No. But sometimes if our tax rates are increasing, perhaps we want to put the income in 2022 instead of waiting to 2023 where the rates are going to be higher. So let's consider that. Also, maybe we want to look at taking on the personal side some capital gains from our portfolios and pushing our capital losses into the subsequent year. Again, looking at the rates for those years and trying to take the best advantage. How best or ways we may be able to accelerate income into 2022 would be maybe to encourage clients to pay early. Sometimes people offer a little bit of a discount to get an early payment. We want to make sure our closings happen in the year we want them to. And perhaps we even can get some advanced rent payments. There is a special rule about rents, no more than 12 months. So look at that. The individual tax rates are, again, we've got 7 brackets, and we have to look at what our filing status is so we can determine what bracket we're in. These are the rates currently for 2022, and you can see 10% up to 37%, plus there are some additional taxes for investment income, as well as if you're a high W-2 earner. So you can actually push this up into more around 41%. So be aware of that. And you can see where the brackets change. Joint filers looks very similar to double, switches slightly when you start getting into some of these bigger brackets. And also note that head of household have a slightly different rate from single up to the 22% bracket, but once they hit that 22% bracket, they're filing in the same brackets as individuals. For 2022, corporations have a flat rate of 21%. I only kept this slide in here and just changed the rates to 21% because I wanted to show how we had the increasing rates back. They started at 15 and they would move up very rapidly and then go back down again. This may happen again. We don't know. What are the new proposals? When will they take effect? Is it 26%, 28%? There's numbers batted around out there, but just be aware. So another thing I'd like us to consider is perhaps shifting some of our income from a top bracket to a lower bracket. And how might we do this? We may do it by paying our children. So instead of handing out money for chores or however we currently do it, maybe we want to ask our children to actually come work in the business for us. Now, we have to be reasonable and, we have to be aware of rules for child labor and who can work for whom, and also be aware of the issue for reasonable compensation. So we can't pay our kids $100,000 a year to empty the trash bins. So it must be reasonable for the work that they perform. Something to consider along with that is that perhaps they could make a IRA contribution and maybe even a Roth IRA contribution, so they could have some funding growing for them as they're growing up and maybe have a little nest egg for a home to purchase when they marry or even for college education. So taking Schedule C earner, paying $6,000 to their children to do maybe some social media posting, reduces their tax, maybe even a bracket, maybe from 24 down to 22, and gets the full $6,000 deduction at that rate. And the child's standard deduction is $12,950, so they're actually paying zero tax. So you've shifted that $6,000 deduction at paying tax at 24% to zero. So let's consider that if that's an option for us. We also might consider gifting some income producing assets. My favorite example of this is when we ship the kids off to college. Maybe we have purchased a rental property in a location where they're now going to attend college. Maybe we gift that property to them, and so that rental income is then being taxed at their rates and not our rates. So something to consider. Now, one of the things we need to think about when we're considering shifting income to our children is that if they have any non-earned income, meaning like interest from savings accounts or dividends from maybe some stock investments, that has to be less, that non-earned income must be less than $2,300 to keep them in their own tax brackets and not have that income taxed at the parents' brackets. So again, there's some planning that we need to consider when we're looking at these different strategies. Something we may consider on the personal side is when do we want to sell our losing stocks? I know now we've seen the market drop, and maybe our broker has said some of these things aren't going to come back for a while. Do we want to actually sell it now, take the loss? Talk to your advisor before doing this, but think about it in terms of tax planning, and this is why we're talking about these things now. Also, look at if we've got some loss carry forwards, when's the best time to take advantage of those for tax planning purposes. On the flip side, we want to think about capital gains. For a while, they were talking about raising the capital gain tax rates up, or maybe eliminating the 0 and 15% brackets. I haven't heard a lot of talk about that recently, but it's certainly something that they may consider doing. So we need to keep our eyes and ears open to see what some of the new proposals are. But currently, if you're single, up to $41,675, you could be in the 0% capital gains bracket. So again, watch these brackets. And if you're single, up to $459,750, you're in the 15% bracket. But once you go over that, you're throwing yourself into the 20% capital gains bracket. So just be aware, there's different limitations for married filing jointly, as well as head of household. And I just want to comment that capital gains are matched to capital losses, meaning for the entire year, you would look at what your capital gains are and what your capital losses are, and then you would net those two together. So if you had capital gains of $10,000 and capital losses of $5,000 for the year, you would net to $5,000 capital gain. On the other hand, if your losses were $10,000 and your gains were $5,000, you'd have a net capital loss of $5,000, but capital losses are limited to $3,000. The net is limited to $3,000 or $1,500 if you are single or married separate. Talking about investments, we want to understand mutual fund timing and when to buy and sell. The mutual funds have requirements to report capital gains and losses and dividends and everything passing through. So understand when we purchase them and when we sell them, what's actually going to show up on our 1099 for the year. So you could get an indication of this from your broker or actually call the funds to give you an idea of what could be happening for the year. And then finally, one of my other items that I really like to mention to business owners is choice of entity. You can change your entity choice. You do not need to stay with what you started out as. And a lot of times individuals will start a Schedule C because they're going to kind of try out the business, see how it works, but doesn't mean you have to continue as a Schedule C. Or sometimes they start out as a single member LLC, then they take on partners, then they're looking for investors, and sometimes the corporate structure is more potentially valuable for investors. So don't think you're stuck. There are ways to change your choice of entity. A business, when it first starts, has to make a determination whether they're going to file accrual or cash method. Generally, business owners start with the cash method, although sometimes when you actually look, an accrual method may be best for tax purposes. So don't just assume. Look at it, plan. There is a special 2.5-month rule for accrual basis taxpayers. And that means that if you accrue an expense on December 31st, you must have paid it no later than 2.5 months after the end of the year for it to be a true tax deduction. So don't forget to pay it once you accrue it. You have a little bit of time, but don't forget. And then there's also some special rules about related party accruals. When should you change your entity choice? That's something that you need to be looking at now. Some of the changes won't be effective until a subsequent year, although there may be ways to end your year, have a short tax year, and start a different entity. So always be thinking and planning. It could happen, but sometimes it may be something that will go into effect in a subsequent year. For example, an S corporation, you must have major election by March 15, 2022 for it to have been S corporation eligible for the whole year of 2022. So your next opportunity would be in the first 2.5 months of 2023. Sometimes if there was a mistake, there are some opportunities to file a late election, and the rules are very specific about that. Other things to consider relating to this choice of entity is Sometimes we want to have an impact on compensation. Maybe we need a higher W-2 to make a larger retirement contribution. Keep in mind that will also probably entail higher payroll taxes. But again, we've got a plan, maybe a little higher payroll taxes to get a bigger retirement contribution might be in your best interest. And also with a pass-through entity, single member LLC, sole proprietorship, you're paying self-employment taxes in addition to income taxes versus sometimes having a actual W-2 paycheck is easier to get those taxes paid in throughout the year. So sometimes choice of entity changes based on something maybe as simple as when those taxes are getting paid. So that is the top 10 things I like to think about. There's all kinds of planning opportunities available. Like I say, if you're thinking ahead, there's questions to be brought up and how might we deal with. So definitely be planning before the year end. The items we covered today were filing status, dependents, retirement plans, Section 179, as well as bonus depreciation, talked about accelerating income, potentially deferring deductions, hiring our children, looking at capital gains and losses, how mutual funds may impact our situation, and also choice of entity. So remember, we're planning and we want to keep our profits in our pockets and not with the IRS. So if anyone has any questions for me or any comments, I'd be happy to entertain those now.
Hi, Cathie, it's Adrian.
Adrian, do you?
Yes, you're always
Did
one
you
step
see
ahead of
any
me.
questions from anyone?
Not as of yet. I don't. That's what I was just about to say is hi. I don't see anything in the Q&A as of yet. If anyone does have any questions, I can unmute since there's just two people on right now. If you'd like, and other than that, I certainly appreciate you for this presentation and the valuable information, Cathie. I thank you for all of the attendees, and just remember that we will send out all of this information. Let's see, we have one in the chat. Just thank you very much, and that's from Mary to you, to everyone, Cathie. But you can always visit our website, the nmsbdc.org, to view our upcoming no-cost webinars more along the lines of these, and to sign up for our no-cost counseling services. Anything from you, Cathie, with your final steps? Or any comments?
I just want to thank you for attending, and please, please, please start your planning process early. And also, please, please, please consider all the different classes and opportunities the New Mexico Small Business Development Center offers, as well as SCORE mentors. They're all available to help you at no cost. So please take advantage of that opportunity.
Absolutely. All right. Well, thank you so much. I'll go ahead and we'll close out the webinar. We just have.
Thank you all.
Absolutely. Okay, I'm going to pause.